Hello everyone, my name is Nikita Polishchuk and I'm a financial analyst at PHC Advisory Tax Accounting, part of DP Group. In today's video, I would like to discuss the recent announcement of the introduction of the corporate income tax in the UAE and the impact it would have on the businesses in the region. So to the topic of today's video, introduction of the corporate income tax in the UAE and its impact on businesses. First, I would like to focus on these following 4 topics in today's agenda. Firstly, I would like to introduce the general business environment of doing business in the UAE, as well as the taxation regime in the country. Secondly, I will focus on the topic of today's presentation, which is the introduction of the corporate income tax regime. Third, I will compare the impact that the corporate income tax regime shall have on the mainland businesses versus the free zone businesses. And finally, I will provide some commentary for the future developments and some of the key takeaways. First, I would just like to mention a few words about the UAE and its business environment. When choosing a destination to set up a business overseas, there are many factors to consider. If you look at the UAE, it is indeed a very attractive destination from many perspectives. Firstly, it is one of the most attractive trade regimes in the Gulf region and the Middle East, and in general in the world. Of course, it's one of the main reasons many businesses and entrepreneurs would like to establish their presence. Second, it has a well-established infrastructure and reliable banking system. The picture on the left serves as an example of technological infrastructure advancement that Dubai, for example, has achieved over the years. Third, free zones have been introduced that permit 100% foreign ownership. Combining this with an attractive tax policy, the UAE seems one of the leading destinations globally for setting up a company. Some other factors include the absence of foreign exchange controls and a stable political environment, which of course are very important for global investors today. The United Arab Emirates has for a long time attracted multiple wealthy investors from across the world to establish their presence in the region, as well as to enjoy one of the most preferential tax regimes in the world, in a jurisdiction which has multiple bilateral double taxation agreements signed with other countries globally. The UAE has long enjoyed the role of a leading international financial, commercial, energy, and tourism center in the Middle East region. Furthermore, no personal income tax, capital gains tax, dividend tax, gift tax, inheritance tax are applied to the residents of the UAE. Furthermore, prior to 2018, the UAE didn't have any sales tax or so-called value-added tax. But in 2018, the UAE, for the first time, introduced the VAT at the rate of 5% on a federal level. It would generally apply for most goods and services. But we noticed that goods and services that are exported outside the territory of Gulf Cooperation Council are exempt from VAT. Meaning, if your company is registered, for example, in Dubai, but you perform the activities, for example, services, overseas and receive payment in Dubai, such payment is exempt from VAT by provision of the relevant supporting documents. Gulf Cooperation Council consists of Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the UAE. Generally, for all UAE businesses, the mandatory VAT registration threshold is set at 375,000 dirham or $102,000 in a year. When sales of a company exceed this amount, it must register with the local tax authorities and file the VAT declaration quarterly. It doesn't matter if the revenue is subject to VAT or not, registration and filing have to be done. So, prior to the recent announcement, the UAE imposed corporate income tax of 20% only on branches of foreign banks, as well as CAT at the rate of 55% on the oil and gas sector at the Emirati level. But the authorities, the UAE Finance Ministry, have announced that it shall introduce corporate income tax or CAT in the Emirates in order to combat international tax avoidance practices and unite efforts with the tax bureaus of other countries to set a minimum global tax rate for multinational companies. Of course, this is likely referring to the agreement reached by the OECD with more than 130 countries globally, aiming to set a minimum tax rate for multinationals. The statutory CAT rate is set at 9%. The new CAT will be levied on the profits derived by businesses from commercial activities in the country. The only category of the activity which is subject to a separate CIT remains the extraction of natural resources. But for small businesses with taxable profits, which do not exceed 375,000 dirhams or 102,000 US dollars per year, the CIT rate is set at 0%, basically, in order to facilitate the development of small businesses and startups. The dependence of the federal budget on the revenues from sales of oil is, of course, another factor why the UAE is introducing this new regime. By diversifying away from the natural resources, from the sales of natural resources, and deriving revenues elsewhere, the UAE can bring further stability and assurances for the future prosperity of the country. But what about the companies which are registered in the free zones? As I mentioned, the UAE, and in fact, in particular, the Emirates of Dubai and Abu Dhabi, are home to many different free zones. Many of these free zones offer different incentives to companies, and I have seen a number of both multinational and small and medium-sized enterprises registering 100% foreign-owned subsidiaries. Free zones also offer certain tax incentives to businesses registered there. The Ministry of Finance had indicated that businesses in the free zones would be subject to the new corporate income tax. But it is noted that the tax incentives which are offered by the free zones will be honored by the new regime for the businesses that meet all compliance requirements and do not conduct business domestically with mainland UAE enterprises or individuals. Further comments from the authorities are expected to bring about additional clarity and transparency of the matter. Nevertheless, it is looking likely that for the businesses registered in the free zones, the preferential regimes of no taxation would continue to apply. And to some of the key takeaways. Many UAE companies and branches of foreign companies have for years enjoyed a 0% tax treatment for profits which are generated in the UAE, both in the free zones and on mainland UAE. The introduction of the corporate income tax is going to change the situation. Free zone tax commitments and policies would continue to be honored as long as no business is conducted in the UAE. While the relevant legislation has not yet been published, international groups, international companies with businesses in the UAE are advised to consider the potential impact of these changes on their operations. I also would like to notice that PHC Advisory Tax Accounting, together with its sister company, Dandran Partners Legal Counsel, which are both companies of DP Group, offer full-scale legal, compliance, and tax advisory support and consulting services to businesses which are willing to or already are conducting businesses both in mainland UAE and the free zones. For more information, please feel free to contact us at the email addresses indicated on this slide. Thank you.
If you would like to know more or have any other questions, please feel free to leave them in the comments below or contact us directly by email indicated in the description of this video. Thank you.